Bloomberg Audio Studios.
Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Charlie Paladin for Doug Krisner this week. South Korean policymakers urged calm in financial markets a day after a martial law row that stunned the nation, renewing their pledge to take all possible steps to rein in volatility that could still increase ahead of Donald Trump's return to power next month. And for more, we heard from JPMorgan chief Korea economist Park Seok-gil. He spoke to Bloomberg's Sherry An in Seoul.
Seok, great to have you with us, and thank you so much for coming out in this cold weather. We were talking about some of the market risks. What are the immediate economic risks for South Korea as this political chaos could continue?
As you know, it's obviously the surprises to the financial, the political noises, but at the same time, we do have our benchmark cases back in 8 years ago that similar political noise happened. And at that time, the benchmark says that we do have some modest degree of slowdown in domestic consumption and the service industry, service activities. So I think it's the broadly similar drag may happen in the near term.
I remember 2016, 2017. I mean, it was a really, really cold winter as well, and that the impeachment of Park Geun-hye happened. We saw people pulling back a little bit when it came to consumer spending because confidence was hit. What are we expecting in terms of the South Korean economy now when it seems that it's at a relatively weaker position than it was back then?
You're exactly right. Actually, the shock may be the same, but the economic backdrop may be a bit different because in 2016-17, we had an off-cycle of fixed investment, while we are going through some slower cycle in the domestic sense investment. So even if the same sentiment, shock may have some different impact than that time and now.
And I keep talking about deja vu because, I mean, even back in 2016, that was when the first Trump administration came in a weird turn of events. Now, 8 years later, that's happening again next year. The threat of tariffs, the threat of changes to the global supply chains, is that going to meaningfully have an impact on South Korea?
Again, this is some good reference with the first Trump administration and the second one. But the lesson we learned is that there is not only bad thing happening. There is some positive thing as well. But in the immediate shock, then we expect that the tariff shock, if it happens, then it will drag down the credit export on the next year. So that's why we expect a slower GDP growth next year. But still, 1.7% in our expectation is not a breaking down from the potential level, so it's modest drag, which is expected from the trade tension. What matters is the global backdrop, whether it is breaking down for more serious retreat or not. Currently, we don't expect so.
Yeah, I mean, the Bank of Korea governor was talking about how the latest political events would not necessarily lead to an increased likelihood of another rate cut. What are your expectations for the rate path in 2025?
What will ultimately matter is the assessment on output gap and inflation and the financial stability issue. Solely based on this political noises, yes, he may be right. But looking through all things going together in our assessment, and still the BOK is stepping toward the modest degree of a neutralization of the policy stance to neutral. What matters is what is the neutral, whether it's a 2.5 or lower than that. That will be the key question.
This really seems to be a matter of prolonged political chaos depending on how even the impeachment process goes. What should investors and markets looking at South Korea be focused on in the next few months?
This type of political noise is really hard to forecast. So I'll say in terms of the economic forecast and market implication, we need to focus more on the fundamentals. And the fundamentals suggest that some modest drag going on, as you say, but still it means the Korea has some resiliency in terms of the portfolio of this export and the size of the domestic demand. And actually the rate cut will help the beefing up the consumption going forward. So I think we need to take a balanced view on that.
Right now, Han Dong-hoon, the leader of the ruling party, saying that he will prevent the impeachment bill from passing. But the whole reason that we're at this stage in the political scene here in South Korea is that there was this wrangling over the budget for 2025, right? And a lot of Components of that budget include funding for key parts of the South Korean economy like tech and semiconductors. Long-term economic fundamentals for South Korea in terms of its competitiveness against other economies. What is JPMorgan's assessment?
Still, there's some diversification across the sectors, including the export itself is quite good, but among the export, there is a rising sector versus the falling factor. So on that, we need to be mindful about the falling sectors as well. But on that, I think it's on the trend for still the robust export sector. In terms of the policies and the fiscal policy, probably, budget will be passed ultimately, but it may be a near-term drag, but in the longer term for the next year, anyhow, I expect that the budget will be less constrained than before.
Seok, Chief Economist at JPMorgan, here with me outside of the National Assembly.
Welcome back to the Daybreak Asia podcast. I'm Charlie Pellet. Doug Krisner has the week off. South Korea's political turmoil is adding to investor uncertainty as they are taking a cautious approach, with some downgrading the nation's shares and preferring to invest in other countries. However, Jeff Grills, Aegon's head of U.S. cross-markets and emerging markets debt, says despite what's going on in South Korea, he sees a buying opportunity in the country. And he spoke with Bloomberg's Sherry On and Heidi Stroud-Watts.
Where does this volatility go from here? We heard from the BOK governor saying that this would be short-lived, given that it's only a political event and not necessarily affecting economic fundamentals.
Yeah, hi, thank you. So I think that there'll be a lot of focus on what will be the next steps with regard to the president. It seems like his term as president is likely to come cut short. But if it's a pretty quick resolution to go to next elections, there'll be some uncertainty. But I think what you're seeing in the markets is really a testament to how strong the Korean economy is, the fundamentals that underpin. And so the reason there's been a muted reaction is that any type of weakness is seen as a buying opportunity. And I think that makes sense. In fixed income assets, we saw spreads widen 10 to 20 basis points. Today, we saw more stability. I think if we get past this, we can start to see them recover back to where they were prior to this event happening on Tuesday.
And long term, we're also really watching the developments around President Trump now taking office in the United States as well, right? What does that mean for South Korean markets, especially in the broader context of EM bonds as well?
Well, there's going to be a lot of uncertainty, I think, with regard to China and to Korea now. The Korean president had done a lot to try to strengthen ties with the U.S., with Japan. This is probably a little bit of a benefit to China with regard to how they want to be positioned against the U.S. But I do think that what's going to happen is that when Trump comes in, he's made these tariff threats. I think he's going to enact some of them. I think China is definitely one where we'll see that. But you saw the quick reaction in Mexico and Canada. I think he'll want to see who the next leader is in Korea and try to reestablish that relationship. So I think that all bodes pretty well. I mean, our view is that while the tariff threats are out there, they are unlikely to disrupt too much aside from China, although China is dealing with its own problems. So I think this will provide the opportunity that once we can get past the negotiations and see more positive, settlement and not something as egregious as the numbers that were originally floated, this will be a positive, although it's likely probably to benefit places like Latin America and Africa a little bit more than Asia, where valuations are tighter.
I do wonder, when it comes to going back to your point on China, one of the questions that have been ongoing is how much do you see China as still being that anchor in the EM space, right? We've kind of seen it over the past few years with its domestic property market and other economic issues. It's almost been a little bit more decorrelated from the rest of the basket.
Well, it has. I mean, it was a lot more correlated in the first stages of the property downturn. So you saw a lot of bond prices drop and some sort of contagion that affected in 2022. China is still important, though, right? I mean, it is still one of the largest economies. It will be important for how they respond. The benefit that China has is they've shown a very strong willingness to support through stimulus, even if the next administration here in the U.S. does enact some sorts of tariffs that potentially negatively impact China. I think China's ready to go with stimulus efforts. So we do think that the Asia ex-China is probably more likely to benefit. We're much more optimistic on Indonesia, Philippines, and India. So they will probably be very well supported. There's been very strong appetite for investments. Flows continue to be strong in emerging markets. So I think that, to your point, China can decouple. But as long as it doesn't go into any type of a recession, I think we'll be fine.
Is that decoupling perhaps also advantageous if you're wanting to, hedge away from perhaps a more thematic trading environment across the rest of Asia? If you take a look at, I guess, some of the warnings about global debt and the challenges of fiscal policy and trade policy, who do you see as being most affected across emerging Asia?
Well, I think the good news is that Asia, from a debt perspective, is in reasonably strong shape. You've had Sri Lanka, which is going through its restructuring now, so that'll be cleaned up moving forward. Otherwise, Indonesia, Philippines, they're all investment grade rated credits. So the opportunities there are primarily usually in the corporate space. So that's where we've had a stronger theme. One of the big themes for the last 4 years really, since COVID hit, was that all the governments have done a lot of stimulus to help support their economies, and corporates have been the beneficiaries. And so I think that's the main theme that will continue in Asia. And I think that's, again, why Korea is probably really more of a corporate investment play, at least on the fixed income side. And it's why you've seen a pretty quick stability to those markets where investors view any type of widening as an opportunity to put cash to work into assets that have appropriate spreads and attractive yields.
Jeff Grills, Head of Emerging Markets Debt at Aegon Asset Management. Great to have you with us.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.